Everyone is telling you to just keep buying stocks. That time in the market beats everything. Your financial advisor, the talking heads on TV, even the automated emails from your brokerage account. They all sing the same song. Buy and hold, don't panic, stay the course. But what if that's a trap? What if the next 10 years look nothing like the last 10? History shows us that after periods of massive euphoric gains, the market can go sideways or even down for a decade or more. They call it a secular bear market. It's not a dramatic, overnight crash that dominates the headlines. It's a slow, grinding, wealth-destroying winter that makes life tough for those who follows the old rules. It happened after the Roaring '20s. It happened in the stagflationary 1970s. It happened after the dot-com bust in 2000, and the signs are flashing again. The S&P 500 has had a great run, with a total return closing of around 16.39% for 2025. But under the surface, the gears of the global economy are shifting in a way we haven't seen in a generation. In this video, we're not just going to show you why your stock portfolio could be about to bleed for the next 10 years. We're going to reveal the specific asset classes that thrive in these exact conditions, the same ones the world's wealthiest investors use to protect and grow their fortunes when everyone else is losing ground, year after agonizing year. Section 1. The anatomy of a lost decade. So what exactly is a secular bear market? Let's be clear, this isn't your typical correction, a quick 10 or 20% drop that recovers in a few months. A secular bear market is a long-term period, often lasting 10 to 20 years, where stock market returns are flat or even negative after you account for inflation. Your money, in real terms, is going backward. It's like running on a treadmill and slowly, imperceptibly being pushed off the back. The most dangerous part, nominal stock prices can still go up. You might look at your 401k statement and see that your account balance grew by 15% over a decade. But if inflation ran at 30% or 40% during that same period, you've suffered a massive loss in purchasing power. You have more dollars, but you can buy less with them. This is the silent killer of wealth. To understand what this looks like, we only need to look at history. There are 3 clear examples in the last century. First, the period following the 1929 crash. Everyone knows about the initial crash, but many don't realize the full extent of the pain. The market didn't just crash and recover, it entered a brutal deflationary cycle. The Dow Jones wouldn't reclaim its 1929 peak for another 25 years, finally surpassing it in November 1954. Deflation crushed corporate earnings and dividends. In stock valuations, the famous PE ratios collapsed into the single digits. Then came the 1970s, a period from roughly 1966 to 1982. This wasn't a story of deflation, it was the exact opposite. It was the great stagflation. But inflation was rampant, and just like we discussed, stock market PE ratios were compressed, falling from over 18 down to under 10. Despite corporate earnings growing, the market went nowhere in real inflation-adjusted terms. For stock market investors, the 1970s were a brutal lost decade. While stock prices bounced around nominally, in real, inflation-adjusted terms, they went nowhere. An investor was losing purchasing power year after year. If you had invested $1 in the S&P 500 in 1968, by 1982, after accounting for inflation, your dollar was worth significantly less. Yet, during this exact period, certain assets went on an absolute tear. We'll get to those. And finally, the most recent example, the 2000s. The dot-com bubble burst in March of 2000. The Nasdaq, which was the epicenter of the tech mania, peaked at over 5,000. It then crashed spectacularly. But it didn't just bounce back. It took nearly 15 years, until April 2015, for the Nasdaq to finally, painstakingly, climb back to that same level. For an entire generation of tech investors, that meant seeing zero capital appreciation for 15 years. The decade from 2000 to 2010 is now famously known as the lost decade for the S&P 500, delivering a grand total return of roughly 0%. In each of these periods, the simple buy and hold strategy failed. It failed for over a decade. The very advice that is gospel today would have led you to financial stagnation. Section 2. The red flags of 2026. So, why bring all this up now? Because the warning signs are here, and they are eerily similar to the periods that preceded these past lost decades. Let's start with the paradox. The stock market had a strong run in 2025, gaining around 17%. Wall Street analysts are broadly predicting another solid, if more modest, year for 2026, with average price targets suggesting around a 5% to 11% upside for the S&P 500. They point to resilient earnings growth, potential Fed rate cuts, and excitement around AI as reasons for optimism. But this is exactly the kind of environment we see at the end of major cycles. Euphoria, the belief that this time is different. Let's look under the hood. The first red flag is extreme valuation and concentration. The entire market's performance has been overwhelmingly driven by a handful of mega-cap technology stocks. much of the optimism for 2026 earnings is still pinned on these same names. This isn't a sign of a healthy, broad-based bull market. It's a sign of a narrow, speculative fever. This kind of concentration, where a few stocks carry the entire index, is a hallmark of market tops, just like the Nifty 50 in the early 1970s and the dot-com darlings of 1999. While earnings have been strong, valuations are stretched. Some analysts are already warning that the heavy concentration in expensive AI stocks poses a risk, with the potential for a rotation away from these market leaders in 2026. The second, and perhaps most profound, red flag is the Great Rotation signal. There is a powerful, cyclical relationship between financial assets, like stocks, and hard assets, like commodities. They tend to move in opposite, long-term cycles. When capital floods into stocks, it starves the commodity sector of investment. This leads to underproduction and sets the stage for future supply shortages. Historically, the ratio of commodities to equities has been an incredibly reliable indicator of major turning points. When that ratio hits an extreme low, meaning stocks are incredibly expensive relative to commodities, it has signaled the end of a stock bull market and the beginning of a massive, multi-year, commodity supercycle. This happened in the late 1960s, just before the stagflationary 70s. It happened in 1999, just before the dot-com bust. And according to analysis from firms like Goring and Rosenqueg, we are currently at or near the lowest point for this ratio in over 125 years. This is not a minor fluctuation. It's a profound, generational signal that a massive wealth transfer from paper assets to real assets may be underway. The third red flag is the shifting macroeconomic landscape. For the last decade, we lived in a world of near zero interest rates and low inflation. The world is over, while inflation has cooled in the U.S., easing to 2.7% for the 12 months ending in November 2025. It remains a structural force. We're seeing persistent supply chain issues, geopolitical tensions, and a massive push for decarbonization and onshoring of manufacturing, de-dollarization, and possibility of the debt crisis in America, all of which are inflationary. This brings us to the buy and hold trap. Over a 40-year investment horizon, this strategy generally works. But who has a 40-year horizon with no interruptions? If you are 55 years old and planning to retire at 65, a lost decade is not a small bump in the road. It is a catastrophic failure of your financial plan. A decade of zero real returns means you have lost 10 years of compounding time you can never get back. Your retirement is suddenly underfunded, and you have to either work longer, spend less, or take on significantly more risk at the worst possible time. But what if there was a different way? What if instead of being a victim of this great shift, you could position yourself to benefit from it? Why lose when you don't have to? If you're getting value from this analysis and want to learn how to navigate this changing financial world, do me a favor and hit that subscribe button. We're about to get into the actionable part of this video, the specific assets that have historically thrived when stocks have gone nowhere. This is information you won't get from your mainstream financial advisor. Section 3. The Survivor's Portfolio. Inflation-proof havens. Okay, so you understand the problem. You see the warning signs. The natural question is, where do you put your money? If the S&P 500 is set for a decade of bleeding, what isn't? The answer lies in tangible, real-world assets. Things you can touch. Things that have intrinsic value and benefit from the very inflation and scarcity that crushes stocks. This isn't about timing the market. It's about realigning your portfolio with the economic reality we are entering. Let's break down the key asset classes. The first asset, gold and silver. In times of economic uncertainty and currency devaluation, gold has been the ultimate store of value for 5,000 years. It's the anti-stock. It pays no dividend and has no earnings, which is precisely why it shines when the earnings and dividend streams of companies become unreliable. When investors lose faith in paper currencies and financial promises, they run to the one asset that has never gone to zero. During the stagflationary 1970s, as the stock market produced negative real returns, gold went from $35 an ounce to over $800. It was a life-changing wealth transfer. Today, with governments around the world printing money at an unprecedented rate and geopolitical tensions rising, central banks are buying gold at a record pace. They are hedging their own bets. Maybe you should too. Silver often acts as gold on steroids. It's both a monetary metal and an industrial metal, with its demand increasing due to its use in solar panels and electric vehicles. The downside is volatility. Precious metals can have sharp price swings and they produce no yield, so they are a pure play on price appreciation and wealth preservation. You can go into different directions with investing in precious metals, ETFs, or holding physical bullion, or even owning mining companies. If you want to learn more about investing in gold and silver, check my latest video after finishing this video. The second asset, energy. For the last decade, the energy sector has been hated. It was starved of capital due to ESG mandates and a focus on green energy. This lack of investment has led to a critical problem. We are not producing enough oil, gas, and uranium to meet future global demand. ETFs that offer exposure to oil and natural gas, RIEO, XO, POIH, and PXE. These are ETFs that hold companies in oil and natural gas production and exploration. This sets the stage for what many believe will be a new energy supercycle. Think about it. Even with the rise of renewables, the world runs on oil and natural gas. And as developing nations grow their middle class, their energy demand will soar. But the real outlier here is uranium. Nuclear power is experiencing a global renaissance as the only viable source of clean, reliable, baseload energy. Over 60 new reactors are under construction globally. Tech giants are signing contracts for nuclear power to run their energy-hungry AI data centers. Yet the supply of uranium is in a deep structural deficit. We are using far more than we are mining. Analysts at Bank of America see prices potentially hitting $135 per pound in 2026, a significant increase from current levels. Goldman Sachs also projects sustained price rises due to the structural supply shortage. This is a simple, powerful supply and demand story. The risk, of course, is political and regulatory, as well as the long timelines for new mines to come online. If you want to invest in uranium, then consider the ETFs VLR for companies that generate nuclear energy, and a mix of uranium mining companies as well. If you want a pure mining ETF, consider URNM or URA, but if you want explosive returns, then consider URNJ or individual uranium junior mining companies. The third asset, industrial and critical metals. The entire green energy transition, electric vehicles, wind turbines, and solar panels, is a fantasy without a massive increase in the supply of certain metals. This transition is incredibly mineral intensive. An electric car requires 6 times more mineral inputs than a conventional car. An offshore wind plant requires 13 times more than a similarly sized gas-fired plant. We're talking about copper, lithium, nickel, cobalt, and rare earth elements. Copper, often called Dr. Copper for its ability to predict the economy's health, is at the center of this. It is essential for everything from wiring and plumbing to data centers and electric grids. Analysts are forecasting a significant supply deficit in the coming years. JP Morgan expects copper prices to push toward $12,500 per metric ton in 2026 due to these shortages. Investing in the companies that mine and produce these essential metals can be a direct play on this undeniable megatrend, while demand can be cyclical and tied to global growth. The long-term structural demand from electrification provides a powerful tailwind that is independent of the stock market's daily whims. Companies that produce industrial and critical minerals like BHP, Rio Tinto, and Freeport-McMoRan. 4 ETFs. Think of DBB, BCIM, and PIC. The fourth asset, agriculture. Regardless of what the stock market does, whether we have inflation or deflation, people need to eat. This makes agriculture one of the most powerful defensive assets you can own. This isn't just about buying corn or wheat futures. It's about investing in the entire agricultural value chain. This can mean owning physical farmland, which has historically been an excellent store of value and inflation hedge. It can mean investing in companies that produce fertilizers, seeds, and farm equipment. Companies like Neutron and Mosaic, which are leaders in potash and phosphate, are critical to global food supply. When crop prices rise with inflation, the value of the land and the demand for the inputs needed to grow those crops also rise. The risks here are obvious. Whether crop diseases and changing government policies can all impact profitability, but the core thesis remains unshakable. The world's population is growing, and the amount of arable land is finite. That is a powerful long-term investment case. Taking all of these individual ETFs or stocks can be quite overwhelming. If you want broad exposure into commodities all in one package, then consider broad-based commodity ETFs like PDBC, COMPT, BCI, or HARD. All of these give you exposure into all the assets we talked about earlier. This gives you the peace of mind of putting your money into all of the commodities. We don't know which one will perform the best during this commodity supercycle. Conclusion. So, let's bring it all together. The buy and hold stock market strategy that has worked so well for the past decade is facing a severe test. The combination of high valuations, extreme concentration, and a new macroeconomic regime of persistent inflation and geopolitical instability, they're all historical warning signs of a coming secular bear market, a lost decade for stocks. Wall Street's consensus is for modest gains in 2026, but the consensus is often wrong at major turning points. While the S&P 500 has performed well in 2025, this could represent the final phase of a long cycle, not the beginning of a new one. But this isn't a message of doom and gloom. It is a message of opportunity. These major economic shifts don't destroy wealth. They transfer it. While conventional stock and bond portfolios could bleed for years, real, tangible assets are poised to thrive. We've discussed the key havens, precious metals like gold and silver, as a store of value. The energy sector, particularly uranium, fueled by a structural supply deficit. The critical industrial metals like copper, that form the backbone of our future infrastructure. And agriculture, which profits from the one thing humanity can't live without. For the investor with a higher risk tolerance, looking at junior mining companies in the uranium or copper space could offer explosive upside, similar to how commodity stocks multiplied fivefold in the 1970s. For those seeking stability and inflation protection, physical gold and broad-based commodity ETFs. The key is to think differently, to look at what an asset is, what it does, and how it performs in an environment of scarcity and inflation. You need to stop thinking like a stock market speculator and start thinking like a long-term owner of real-world value. The financial system you've been taught to trust may be about to fail you for a decade, but by understanding history and aligning your portfolio with the powerful forces of scarcity and human need, you can not only protect your wealth, but you can significantly grow it. If you want to keep getting insights that challenge the mainstream narrative and give you the tools to build a resilient portfolio, make sure you are subscribed to the channel and have notifications turned on. The next 10 years will be volatile, but for the prepared investor, they will be filled with opportunity. Thanks for watching.